Hey everyone, welcome to Retire with Style. I'm Wade. I'm here with my co-host Alex, and we're joined by a repeat guest, Rob Cordeau, who impressed us so much last time that we thought we'd have him back again. Rob Cordeau from McLean Asset Management to talk about year-end planning issues, because there's a lot of financial planning issues that come up with the deadline of the end of the year on the horizon, that being a deadline for many different types of taxes and so forth. So we're really looking forward to having an in-depth conversation with Rob in today's episode about the types of issues you'll want to be thinking about at the end of each year, but in particular, the no time better than the present. So what do you want to be doing before the end of 2023? So thank you, Rob, for joining us again on the show. You had so many great analogies and things last time. We thought, well, we need to hear from you again and get some of that expertise.
Thanks. Good to be here.
Yeah, Rob. No, Wade, remember today we had our company Friday meeting today, and we were talking about year-end stuff, like, okay, if get all client requests in by such and such, et cetera, so we can work with our custodians accordingly. And Paula even mentioned the podcast we did with Rob and how well received it was. So he got rewarded by being asked to another one.
Yeah, you do a good job, you get more work.
Yeah, exactly.
No good deed goes unpunished, I guess. Huh?
but yeah, right. So Rob, why don't you this is kind of your episode to a large extent. You're talking to a consumer, you're at a party, and they say, hey, what should I be doing? It's end of year stuff. What should I be thinking about? Because I do think there's certain times of the year that are sort of inflection points for planning, right? They're not April 13th or April 14th or something like that. They're kind of around now, right? And so why don't you take it away?
Well, first, good question. I would say your hypothetical, because I'm so busy with tax planning, I would never be at a party this time of year because I'm too busy.
Is that what it is? Is that what it is, Rob? Really? That's what it is? Okay.
Absolutely.
Wait, remind me to have a separate conversation with Rob after this meeting about denial.
Yeah, take you down to Miami and have a cigar or something.
Right.
Yeah, exactly.
So, yeah, the first thing I look at, it's kind of funny. Usually we talk about tax planning, and most people are in the mind of thinking, well, let's find a way to reduce taxes and let's get those things done before year end. But occasionally I come across clients who are actually in the opposite mode. They're in a unique situation where they're looking to, or they should be looking to, increase income. So that's sort of my first step is find out what my objective is. I'll give you an example. If someone lost a job partway through the year, or they took a sabbatical, or they retired this year and their income is much lower than it's been in prior years, those are all income years where their income's lower, they're likely in a lower tax bracket, and I might not necessarily be looking to max out a 401k or in some way push income down. I might be looking to increase income with something like a Roth Conversion. So the first step is just figuring out what my objective is, which I might not know without a series of other questions, but that's the first step. But for the typical working client, that's usually where they're at. They're usually in a higher bracket in their working years than they'll be in retirement. So we are usually looking for income reduction techniques or income deferral techniques, something that we can do to push an income into a future year if possible, so that we can put less income in that higher bracket during their working years. If it's a retiree, then there's a lot of question marks. I have some retirees that for a certain number of years, I'm looking to produce income for them. So if we're bridging a gap between retirement and Social Security, it might be serial Roth conversions for a number of years until they push themselves up into a higher bracket. So it really depends on their current bracket and expected future brackets. That's sort of what will drive what the objective is.
Okay.
No, it may go without saying, but just to to be a bit more clear about this. Why is it the end of the year where this comes to the forefront? Why not do this in April when you're just paying taxes? I guess just to make sure that that's clear to everyone listening.
Right. I mean, ideally, people should be thinking about taxes throughout the year because there are, techniques that could be implemented at various times, and it's a little less urgent and crazy to do it earlier in the year. But there are a lot of deadlines that fall on December 31st, right? So whether it's executing a sale of an asset to, do some tax loss harvesting or even gain harvesting, that would have to happen by 12/31, or Roth Conversion to be counted this year has to happen by 12/31. So a lot of it is just so many things come to a hard stop on 12/31. And I should throw in a little caveat to that. A lot of custodians have decreased or sped up their deadlines. So in years past, we used to be able to work with custodians, and we could submit paperwork to them on December 31st and execute a Roth.
Real quick, custodians are the Schwabs of the world, the Fidelities of the world, where your money is held, if you will,
Exactly.
where you have your brokerage account.
That's right, could be Vanguard, wherever. But in the past, when they were better staffed, we could submit things right up until year end. But a lot of custodians have pushed those deadlines further up. So now some of them are the first week of December, some of them are end of November. So it's becoming more and more urgent. If you have a year end item that you need to execute, move quickly because you might have a deadline that you're not aware of.
Okay.
And that would just be something like if I wanted to do a Roth conversion in 2023, though I could technically wait up till doing that December 31st, the custodian may not allow for that sort of thing to happen after a particular date, just because they don't have the employees at this point to handle the request.
Yeah, which seems unfair. The IRS allows it. Right? The IRS will let you do it right up until 12/31, but you have to look at things like, does 12/31 fall on a weekend? And then that's not going to work, right? But even more so, as I mentioned, in recent years, most of the custodians, they need weeks to get, because they're running into a crush of applications and things that are rolling in at year end. So good idea to act as soon as possible once you know the strategy.
So we should have had this episode 5 weeks ago.
Yeah, probably. But still, there's still some things you could execute, and good stuff to remember for next year too.
And so as you're having your meetings this year with clients doing like year-end stuff, obviously you talked about taxes, but what does that include? What would and I get it, everyone is different, et cetera, right? But if you're talking to our consumers, our audience here, what should they be thinking about, offhand that you could provide? Maybe there's a checklist in your head that you have, et cetera.
Sure. If I take that one group where the typical working person in a higher bracket, and I want to reduce as much taxable income as possible, I'd be looking at things like charitable donations. So that's another one. You need
Does
to
that
get
have a deadline
donation.
too? Do those have deadlines?
Say it again.
Do those have deadlines?
Yeah. Again, it's really the same tax deadline. So 12/31.
Just wanted to make it obvious.
Get that in the hands of the charity by then. And that could be the form of a qualified charitable distribution, a QCD, out of an IRA. So that's another deadline item, right? If you're subject to required minimum distributions, whether it's on your own account, you're in your 70s, or maybe you have an inherited IRA. In either case, you want to get those RMDs done by 12/31 so you don't hit a penalty there. And if you're above 70 and a half, you can engage in qualified charitable distributions. So get those dollars out of your IRA into the hands of a charity and don't get taxed for it. So that's another one that falls under that 12/31 deadline.
Keep that money out of adjusted gross income, but I think it's always worth just adding, because people might say 70 and a half, I thought it was 73 now, but though the RMD ages have changed, you're absolutely correct. Qualified charitable distributions are still at that 70 and a half age.
Right, exactly. And if someone's self-employed, a couple thoughts come to mind. If they have a good year with their business, They could be looking to accelerate deductible expenses, so making some larger business purchases before 12/31. They could drag their feet on collecting receivables until January if they wanted to push. If they're a cash basis tax filer, they could push those receivables out, not collect them until January. Another thing, if we come across small business owners sometimes who have a SEP IRA or a simple IRA that's been set up, and they come to us and we point out to them that a solo 401k has a lot more flexibility and allows for larger contributions. But there's an interesting deadline there. Although you can fund your solo 401k up until your tax filing deadline, you are supposed to have it set up by December 31st of the year that you're trying to take that first deduction. So if you're someone who has a SEP or a simple IRA and you know that you had a good year, you'd like to sock away more in the way of retirement plan contributions, push your income down further, getting that 401k established now as soon as possible would be important. Let's see, looking through some other ones, pushing down things like...
So this is the theme of, but you're talking now in the theme of reducing
income, right? Okay. Things like if you itemize deductions, or if you might be able to itemize deductions, you could take any discretionary medical expenses this year. So big expenses on dental or something, an elective surgery, something that you could push into the current year. Even bunching deductions, we've talked about that before, just bundling them together.
Like a donor advised fund.
Oh.
Yep, donor advised fund. Yeah, another great example, right? You could, in a year where you have high income, push more than your normal budgeted charitable donation into a donor advised fund. And then over future years, you could parse that out as you distribute it out to charities. So that's another great way to accelerate a deduction.
Wade has an interesting strategy that he recommends a lot, and that's you go to your employer's office and you just ask for a lower salary.
Yeah. I didn't know you were going with that. That's one way to reduce taxes.
Sometimes first order principles, right?
That's good.
No.
That's letting the tax tail wag the dog. Right? I never can get that expression right.
Definitely. I'll give you another interesting one that we've done with clients. This is usually a retiree. So a retiree, let's say they're taking $10,000 a month from their IRA. So over the course of 12 months, we take $120,000 in taxable IRA distributions.
This is a retiree. I'm sorry, I missed the very beginning.
Yes,
retiree.
Yes, a retiree, right. And we get toward year end and I chat with them and I try to find out how they're doing with spending. And if they're not spending as much as we're sending them and their savings account is starting to balloon, then I might say, why don't we stop your December distribution? We won't distribute that $10,000. And we could even do a 60-day rollover of the last $10,000 that you just took November 1st. And we could basically reduce your $120,000 taxable by $20,000 by just engaging in those two. Right. And the 60-day rollover is basically it's like an undo button, right? That the IRS allows you to.
And if they're at a bracket over 20%, whatever one that is, that's $6,000 at least that you're saving them.
Yeah. And it's funny how a lot of our clients don't monitor that monthly payout that closely. So they'll let their checking account balloon sometimes. Yeah. Especially during COVID, people weren't traveling as much. They weren't spending as much.
I think what happens too, and this goes back to time segmentation a little bit, they leave that as like their emergency fund, and they just see that, oh, it's my emergency fund, and so whatever. They'll never say no to money, right? Because it's almost instinctive, right? If someone's cutting you a check, you take it, right?
Right.
But they don't realize that if that money's not being used, you kind of are getting penalized in the form of taxes.
Sure.
Just letting it sit
penalized
there
in the form of missing a rate of return. It's surprising.
Yeah, it's opportunity cost as well. Yes.
Right. I've been asking that question a lot more lately because I'm finding clients with 6 figures sitting in a checking account that's earning a fraction of a percent. And
and it's
even if they
there
knew that.
not purposely. It's
Right.
just one of those things that, yes, and I get it for those listening. Yes, life is good if that's you, right? I understand, mazel tov,
Right.
But other than that, though, I mean, it's just they don't notice, right? And then all of a sudden, it's like, what are you doing, man?
Right.
Is that kind of the conversation?
It is. Yeah. Yeah. And sometimes clients just aren't even aware that, there are options like CDs at 5% these days. So they're not even aware of how much just that one mistake cost them $5,000 to have 100,000 sitting in their checking account for
Yeah,
a year.
but you're bringing up a thing I didn't think about. Obviously, the opportunity cost is one of those things that, present value of money. You got to make it work for you, et cetera, et cetera. But you're saying just the fact that you're needlessly pulling it out, not to mention cap gains. Well, no, because if this is a tax deferred or tax free, fine. But it's going to put you in a tax bracket that that you didn't want to begin with, and off you go. And so
Yeah.
you end up hurting yourself. Interesting.
Yep. Yep. So we don't come across that often, but it does come up. And it's one that I've been asking more frequently about in client meetings is just how do you find your current withdrawal rate is working for you? Are you finding that your checking account and your savings are dwindling, or are they creeping up? And just try to get a sense of whether we're on target with the amount we're distributing.
Gotcha.
Yeah. Another one, getting back to maybe someone who's still working, is just making sure if your goal is to reduce income, that you really are maxing out your retirement plan at work. So the limits for 2023 are 22,500 for those that are under age 50, and 30,000. 30,000, yes, for those age 50 and over. So that's the salary deferral amount that you can put in. So a great way to do that is just look at your pay stub and see what your year-to-date number is, see how much you're doing per paycheck, find out what your pay frequency is, just sort of do the math that way. But it's surprising, we find a lot of people who say to me, oh yeah, I'm maxing out. And they forget that these limits are indexed for inflation and they increase almost every year. So often we find someone who is maxing out, yes, to the 2017 figure that they should have been at 6 years ago. Or people forget about the catch-up that happens once you turn age 50. And that kicks in if you turn 50 at any point in the year. So if you turn 50 on December 27th, you still get to enjoy all that extra catch-up. You have to wait until the day you turn 50. You could be enjoying that all through the year.
Now, what's the scenario? So that's you're trying to dampen your bracket. What's the other scenario where you want to go the other way? You want to increase the scenario, and absent the walking to your supervisor's office or your employer's office and say, "I want to raise."
Yep.
What's another strategy?
Yeah. Things like we mentioned Roth conversions. Roth conversions are great. We're really looking for that initially if we can, because the end result is so nice to have tax exempt income. So if we can create a scenario where someone's in a low bracket, and if we can convert to Roth, that's great. We do this for it mostly comes up for our retirees, and we find oftentimes retirees go through phases where they're in different brackets. I mentioned like someone who retires in their 50s or 60s. They might have the first few years where they're pulling mostly from a non-retirement account. So their income, their taxable income is very low. They don't have Social Security. They don't have RMDs. They're not taking IRA distributions. If they have a pension, it hasn't started yet. So in a lot of cases, all they're looking at for income is dividends, interest, and some cap gains. So they can be in a very low bracket. And that's a great opportunity to engage in some serial Roth conversions. And usually what we do there, go ahead, Alex.
Well, you said something that Wade just published an article on, distribution strategies to keep in mind, and tax efficiencies around that. That we'll have an episode on this in the future. But as we were just discussing it, right before this podcast, we were discussing it. And one of the things we realized in terms of addressing this article is there's some baseline assumptions first that we need to discuss, and we'll do so. And that's the whole sort of, distributions come from, you should think about them as coming from taxable, then tax deferred, then tax exempt, in that order. There are exceptions, et cetera, and that's what Wade's article really goes into. But even before then, because you were talking about accumulation, and you were talking about, there'll probably be some taxable accounts and everything. Tax diversification. This is something that I've seen talked about on Twitter, of all things, advisors, this or that. And sometimes, some people are just, it's malpractice, some of the things they say. Like you shouldn't contribute to a 401k because you're not going to have access to that money until you retire. It just asinine things like that. What is your take on, just as you're building up capital, as you're accumulating, having a healthy dose of assets across taxable, tax deferred, and tax exempt accounts, as opposed to maybe going ordinal by I'm maxing out this group. Once I max out this bucket, then I do the other bucket. Once I max out that bucket, then I do the other bucket. Where do you stand on that kind of thinking?
Yeah, I love it when a client has tax diversification, especially our retirees who come in and they have all three of those buckets funded, because from a tax planning standpoint, it gives me so much more flexibility, right? If I see they're pushing up against an IRMA bracket, I can pull more from.
You're gonna have to say what IRMA is on the bed. Now that you brought that up,
IRMA, right? Yes, IRMA. She's not
and
a
it's
woman.
not Wade's grandma.
Yeah, it's the. I'm testing my memory. I think it's income related Medicare adjustment account or something like that.
Yeah, income related monthly adjustment amounts for the Medicare premiums. It's a real shock to people.
There, but yeah, so
$1 too much income for a couple could lead to $1,800 of additional Medicare premiums 2 years later.
Exactly.
That sort of thing.
Yeah. So we're planning for that while we're also planning for regular tax brackets. We kind of consider that a bracket as well. So I might have someone whose income might push them up into a higher bracket, taxes, IRMA, whatever else. And I might be looking to take from another bucket. Whereas I have other clients who the only bucket I have is a large IRA that was 401k accounts. And I don't have the tax flexibility, right? I can't, if they need the money, I have to give them the money out of the IRA. And if that pushes them over the next bracket, so be it. I can't control that.
No, I think you're right. I think, listen, on an Excel sheet, I get it. Optimize tax exempt, then tax deferred, then taxable. But I find myself, and this is working, obviously all I've known is McLean, right? And I have stories of clients and clients. So learning vicariously through that, I've almost realized, put the spreadsheet aside. For me personally, I always like having a healthy dose of everything because it just gives me so much flexibility. I mean it like if I need a house repair, if I need like spending shocks and things like that, I always like to just have accessible taxable amounts just because life comes at you fast kind of thing. And if I have to take from other buckets, the tax penalty on that will effectively undermine all the potential savings that I would have had along the way. I don't know. I'm not saying, front load one more than the other. Obviously you can tax exempt, deferred, and taxable, but I still like to have accessible assets. That's just me personally.
Yeah. And I think that's important, right? Making sure there's an emergency fund, those sort of things. Assuming those are in place, I do try to turn it more into a math equation and just say, what is my bracket now, which I can usually tell fairly quickly what someone's bracket is currently, and then compare it to a future bracket in retirement. That's where it gets a little bit more art than science. What I've found with our clients who retire, some clients go through 4 different phases of levels of income. There's that first phase between retirement and age 70, when they might have lower income and a lower bracket. Then there might be a second phase between 70 and 73 before RMDs start, or 75 for younger clients, right? And then there might be a third phase once they're after RMD age and they're getting RMD, Social Security, plus whatever else. And then I find a fourth phase often kicks in, which is clients get up to late 70s, early 80s, and their spending slows right down. And this happens with every client I come across, where I don't remember any client the past 27 years who spent the same amount in their 80s and 90s that they spent in their 60s. It just doesn't happen.
Mm-hmm.
So I think a lot of advisors forget that that's going to occur. So they often bring this question down to compare your bracket today versus your bracket in retirement. And my question is, it's not comparing your bracket today, it's compare your bracket today versus what you think your bracket's going to be when you pull these dollars out in retirement.
Good point. Good point.
And that's a very different comparison. And when I'm trying to guide someone as to whether they should contribute pre-tax to a 401k or after tax to, say, a Roth 401k, that's the comparison I'm trying to make, which is an interesting one. It's not. It's a little bit more nuanced. It's a little more complex.
It's a smarter way of doing it. You're kind of getting at it like, worry about the contributions into these assets, absent the spending shock needs, right? Because that, who knows, right? But let's just say you've got those covered, and that was my sensitivity, the spending shock issue. But if you have that covered, then it becomes an issue of contribute to them, knowing, having some sort of at least working expectation, knowing that it'll change, but at least you have a working expectation with all the information you have available to you at the moment of how you're going to distribute them later on, because that will help guide the efficiency around that. That's what you're saying. Am I correct or incorrect?
Correct. Yeah. Well, getting back to my example of a bridge there between retirement and age 70, if I was fairly confident that someone was going to retire at 60, and I'm talking to someone who's 50 about it, and I knew that we were going to have a good 10 years where we could engage in these Roth conversions, that's going to play into my decision as to whether I think they should contribute to Roth or to IRA. If they're in a higher bracket at age 50, I'm not worried about them putting pre-tax money in. They're going to save money on their bracket now, and we'll get to converting that later between ages 60 and 70. You know what I mean? So it's a big picture kind of thing. It's not just looking at the current year. You got to look a little deeper than that.
Yeah, and that it's that kind of, if you are in the peak earnings years, there's likely going to be an opportunity to pay taxes in the future at a lower rate, and so you get the tax deduction today, and vice versa. But keeping in mind that having that diversification is important. You want to have some of every type of account.
True. Yeah. And it's, a lot of people think, well, I'm always going to be in a pretty high bracket, but it takes a lot to get up to the higher brackets. When you think about it in retirement, only 85% of your Social Security is taxed, so 15% of it comes out tax-free. If you have non-qualified investments, then your cost basis comes out tax-free. And the capital gains, if you do it right, come out at 15% or 18.8, depending on whether you're exposed to the net investment income tax. So, it kind of takes a lot more income than what you normally think of. When we're in our working years, we're thinking our gross income, and that's pretty close to our bracket, right? Minus, whatever we contribute to plans and so forth. So I think that's important to remember, that it's very likely you're going to be in a lower bracket. Even clients who've accumulated several million, it's pretty common for us to keep them in the 22% bracket in
I don't
retirement.
know, Rob.
So,
Have you seen Wade's book sales? They're going off the charts. This
yeah,
guy, this guy is
great.
No, that's you're right. I mean, the reality is you're right. As much as people think, no, it's just going to be this tree is going to grow to the sky in terms of their income. Not so fast.
Yep. And even if it grows according to plan, and we have a lot of clients that have 4, 5, 6 million, and we can keep them in the 22% bracket, getting a sense for what you think you will be spending in retirement is important. And you could be spending $250,000 a year and still fall within the 22% bracket as a married couple.
But this takes some engineering. I mean, so going back to even the original piece, it's year end. One of these clients comes in, obviously taxes. Then let's say from 1 to 10, that is from 1 is like minimum. Hey, how you doing? Market looks good. You look good. Great. See you next year. 10 being the most comprehensive, year-end thing you could do. Taxes take up about how many quantum units of that?
Oh, for that client, yeah, I think taxes are critical to just about everything we do, right? I mean, it's, if you're making estate planning decisions, taxes are usually
Yeah,
involved.
that's
If
true.
so even
Taxes
so,
touches every single one of those units. If you're
it
doing
really
year-end,
does.
tax is
Distribution
going to hit
planning,
everything. Okay.
yeah. So, getting back to this shouldn't just be a year-end discussion. It should be
No.
something that pops up with each review. Um, but I think we're talking about it now because we're getting close to year
Yeah,
end.
so year-end is really predicated on deadlines because the deadlines make it, and nothing spurs action like a deadline. Ultimately, right? Okay.
Well, maybe talk a little bit too about, it's not the deadlines is a big part of it, but also if you really are trying to engineer a specific income to, say, avoid Medicare, the IRMA surcharges and whatnot, and you're doing Roth conversions, you kind of have to wait until you know what all your other income's going to be for the year. And part of that is you have to wait for those end of the year. What are the distributions going to be from your taxable brokerage accounts? And only when you have all that in place can you then finally decide, what should my Roth conversion for the year be? So that's an important consideration as well, right?
It is, yeah, and we probably do, I don't know, 75 to 100 tax projections per year, and I would say a third of those we can do early in the year, and that's usually for a client who only has qualified accounts. So it's a retiree, all they have is IRAs, and we know what they spend for the most part. We can get a pretty good sense of what their income and their deductions are going to look like early in the year. But for at least 2/3 of our clients, we try to wait, and this is a balancing act. We try to wait as long as we can in the year because the projection is most accurate the later we wait, right? But not so late that we miss deadlines. So October, November, and December is a little crazy for us doing projections. That's why I don't show up to those parties. I'm just too busy.
It's not me. It's not
It's
me.
not you. It's not you. Contrary to what Wade might have told you, it's not you at all.
Exactly.
Yeah.
No,
So
you will be
you,
able to
you, you
take
kind of are
Thanksgiving
like,
off. Are you going to be working on Thanksgiving?
yeah, probably. Yeah.
Oh no.
It gets a little crazy for us, right, as we get to year end. And as you mentioned, there are estimates that come out from mutual fund companies. So if you have a non-qualified account, mutual fund companies might come out with estimates for their funds. Here's what we're going to pay for a dividend or long-term capital gain distributions. Some of those pay them out mostly or entirely at year end, like mid-December. So some of those estimates don't show up until November. So it's a little tough to, if you have a sizable non-qualified account, to be able to estimate large amounts of dividends. So it does compress the planning work into this very short period.
So Rob, as Wade and I were talking about his article and how we would present that in an episode, one of the realization was that there's all these things you could do and analyze, but the backbone of much of that analysis comes from financial planning software. Specifically, the one we're talking about is Covisum, and that's not something that's available to retail audiences because there's no business. There's not enough of a demand to put something of that high level to individuals.
And too much need for hand-holding with the software. That's just not feasible.
Yeah, they wouldn't be able to do it. It wouldn't be cost effective for any company to do that. But advisors, they can do it, et cetera, et cetera. Obviously, we have a lot of consumers here and a lot of advisors that listen in. But for the consumers that are listening in, absent of saying, well, that's why you should call McLean Asset Management. I don't mean to sound like a commercial by any means, but what a consumer who's left to his or her own devices is listening in and is thinking all of a sudden, you know what, I gotta kind of like assess this and see where I'm at. What kind of quick and dirty thing can you tell them up until you say and pick up the phone and call an advisor and go from there? What's left to them to do?
One kind of quick and easy way to do it, if you're someone who does your own tax returns, so you use TurboTax or one of those pieces of software, is to go back and just plug in your income. Now it's not going to have the current year yet, but you could kind of put it in, and that gives you a sense. It's not going to be perfectly accurate because it's not indexed for inflation, all the brackets, and that's a quick way. Another way is to literally pull up the tax brackets and really do the math, right? You look at your gross income, subtract out your things that aren't taxable, like what you pay into your Section 125 plan at work, and subtract out what you've contributed to your pre-tax 401k at work, and come up with what your taxable income will be, kind of work it through basically on a 1040, lacking a full-blown piece of software to do it for you. Those would be kind of some of the things I would look at. I mean, we use a piece of software that's really designed for advisors and tax preparers. I mean, we don't prepare taxes at McLean, but the software is great because we can project out, we can plug in all the assumptions, and it can tell us exactly how far we are away from the next bracket. It's just useful to be able to tell us, okay, optimizing it, we could fill the next bracket with a $17,000 Roth conversion. That's the amount it would take. And if we went, to 24,000, we'd start bumping up against the ARMA break point. And if we went to this other point, we'd exceed, this $250,000 level, and they'd be subject to the 3.8% NIIT. So there are so many competing objectives in terms of breakpoints and brackets that it can be challenging. I'll give you a couple of others that don't show up in a piece of software. Would be we have some clients who get subsidies from pharmaceutical companies. So they take a particular medication. It's extremely expensive. Some of these medications are over six figures. And the pharmaceutical companies will sometimes provide a subsidy, but only if your income's below a certain level. We had one that was $100,000. So we had to plan, it was worth about $45,000 a year to this client for us to not exceed $100,000 by even $1, because if he exceeded by $1, he would lose his $45,000 subsidy. So for each client, we have those sort of targets that we're looking at. Or somebody might be under 65 and they're receiving the Affordable Care Act subsidy, and we can keep their income a little lower, get them a larger subsidy, and that's important for us to keep an eye on. So there's sort of all those other things that might not even show up in a piece of software. You just need to know them for each particular, investor.
So if I'm kind of trying to think about this big picture again as a listener, what I'm hearing is, look, year-end planning is important, and sure, you can do the obvious of maximize the accounts you need to be saving into, et cetera, et cetera. But there's different levels to this. And where you really begin to move the needle, besides the obvious of just maximizing, is just the tax planning component of it. Because as you retire, there are a lot of little gotchas, if you will. As Wade would call them non-linearities, right? But there's a lot of little gotchas that you have to be aware of that you can inadvertently run into that will undermine a lot of work that you've done during the year. And that's what you have to watch out for, because if not, you're leaving money on the table. Is that a correct sort of most common denominator explanation?
It is, yeah. And it's surprising to me how many prospects, new clients come to us, and no one's ever explained something related to taxes to them. And even if they've come from another advisor, we had a client come on board who had access to a 457 plan through his employer and access to a 403B plan. And he didn't realize that you could maximize both of those. And that's one of those rare, lucky individuals who has access to that. And we explained it. And he's like, how come nobody ever told me? And from that point forward, he was stuffing, an extra, whatever it was at the time, $20-something thousand into that plan, just because he didn't know. Or, we do a lot with backdoor Roth IRAs for clients whose income is too high to contribute to a traditional, regular Roth IRA. And that's a strategy that takes a little work to get it right. It's a little more complex. And We find a lot of accountants don't even know how to fill out the Form 8606 to account for that correctly because it's so complicated. So we've become sort of experts in backdoor Roth IRAs. And another subtle year-end issue with that is it's important not to have a large IRA existing somewhere in the year that you convert your backdoor Roth because of the IRA aggregation rules. The IRS will have you sweep in all those other IRAs when you're calculating the tax percentage. And we've run into cases where clients engaged in a rollover. So they did the backdoor Roth early in the year, and then later in the year, they did they left a job and they rolled their 401k out to an IRA. It's important to fix that before year end because the IRS is going to look at your balance on 12/31 of the year of the conversion. So that's a mistake that you could fix. If you were in December, you could do a roll in to another 401k plan, get that IRA empty so that you don't mess up your backdoor Roth aggregation rules. So there's a lot of subtleties like that. It takes working with an advisor who's very tax centric, who's going to look for those sort of things.
That's fantastic. This is like a masterclass in of itself, huh, Wayne?
Yeah.
See this guy flexing on form whatever. And for the record, he's not reading anything. He's just like top of his head.
Right.
We need you and him together on a Jeopardy and see who comes out here. It's a little kind of
struggle on the tax side. But, yeah, this episode didn't have a script. We're letting
just let Rob go.
Yeah. And just a couple of other last minute things that I had.
Here we go.
Two more quick ones.
No, have at it, man. This is fantastic.
Flexible spending accounts, right? So a lot of those have a year end of 12/31, and I think it's like $610 that can roll over or something. If your plan elected it, they can roll over some of it, but it's best to look at that as a use it or lose it kind of account and get those expenditures in before the deadline. Dependent care, flexible spending accounts, those don't even carry any sort of rollover provision. So you need to use those up by whatever the deadline is. And a lot of those deadlines are 12/31. So gifting, if you're into estate planning, you're trying to get money out of your estate, that's $17,000 annual gift tax exclusion. That's, use that up if you're doing that. Get those gifts done by 12/31. Another strategy we've used with clients with a 529 plan, you can front load 5 years worth of gifts into a 529 plan. So if you wanted to do that, get that done now, and that would start that clock rolling, and you could literally make another contribution just a little more than 4 years later, right? Because we're so deep into 2023. Or alternatively, if you wanted to do 6 years worth of contribution, you do 1 year now, and then in January you could do the 5-year front loading, and within a month you can get 6 years worth of gifts all in without running afoul of the gift tax.
Yeah, I'm just hearing this and thinking, wow, there's obviously we take it for granted because of the position we have at McLean, and we just see this every day. But there really is a lot to be done beyond just. I think people think to some extent planning is just budgeting. It's really not, or it's just Monte Carlo projections about your portfolio and some sustainable withdrawal rate. That doesn't even scratch the surface. As you saw, every bullet point that Rob mentioned here is an episode in and of itself. I mean, you can really unpack that, to a large extent. But like I said, it's end of the year, things you want to be talking about. This is where it really is about tightening up loose ends, or making sure that things are being taken care of, but in this manner. And it's huge. It's not just a pat in the back. Hey, see you next year. It really is. This is when a lot of the work is done. Frankly, in my estimation, between October and March, those are the heavy lifting months by far. When it comes to planning. So I'll thank you for this little masterclass on year-end planning ideas to be thinking about. Obviously, taxes play a big role because. Look, at the end of the day, they touch everything, and that's fine. So thank you for that, Rob. Wade?
Oh, you're welcome.
Yeah, thank you, Robin, and thanks everyone for listening. And we do wish you all a happy Thanksgiving. I think this is going to come out the week of Thanksgiving with the way we're planning things. So enjoy Turkey Day, and thanks for listening.
Gobble, gobble.
Thank you, Rob.
Thank you.